Hello viewers, today we discuss income tax law and practice. Now, under this we discuss income tax law and a scheme of taxation. Now, income tax law. Understanding of the income tax law requires a study of the following: the Income Tax Act 1961 amended up to date and Income Tax Rules 1962 amended up to date. Now, Income Tax Act 1961 that contains 298 sections. Now, under these sections we find various provisions regarding calculation of income, calculation of tax liability of an assessee. At the same time, we also study what are the different powers and authorities which are given to different assessing authorities. Now, Income Tax Rules 1962, it has come into existence from 1st April 1962. Now, that contains those rules which are framed by the CBDT, say Central Board of Direct Taxes, which are made from time to time by the CBDT in order to smooth implementation of different income tax provisions as contained in Income Tax Act 1961. Now, in order to have the assessment of income, we have to see the notifications and circulars and clarifications issued from time to time by the CBDT. Now, CBDT sometimes requires to issue notifications and circulation, because sometimes there might be some sort of confusion in respect of rules and provisions of the Income Tax Act. Therefore, notifications and circulars are issued so that any confusion in respect of any rules can be removed. At the same time, we had to see the different decisions taken by the Supreme Court in respect of assessment of income, penalties, weekends appeals and revisions, so that the tax liability of an assessee can be calculated without any difficulties. Now, friends, we have to discuss today what is the scheme of taxation. Now, under this scheme of taxation, we have to study first of all what is the previous year. Now, previous year means the year that is commencing from 1st April and ends on 31st March of the next year. Now, this is uniform previous year. Why? Because every assessee under the Income Tax Act is bound to adopt this type of the previous year beginning from 1st April and ends on 31st March of the next year. Or we can say that assessee has no liberty to adopt the previous year other than this. Now, this sort of uniformity was brought about in 1988-89. Before that, every assessee was at full liberty to pick up the previous year of his choice. So, we can say that prior to 1988-89, we find variety in the previous year, but with effect from 1988-89, it has been made compulsory for all assessee to adopt the previous year commencing from the 1st April and ending on 31st March of the next year. Normally, the previous year is of complete 12 months, but there is one situation in which the previous year can be shorter than the period of 12 months, because if business has set up in the previous year or new business has been started in the previous year or a new source of income has taken place in the previous year, the previous year will be shorter than the 12 months. Suppose we can take out an example. Suppose Mr. X has set up a business on 1st July 2011. Now, in this case, the previous year will be of complete 9 months beginning from 1st July and ending on 31st March of the next year, say 2012. But in no case the previous year will exceed the period of 12 months, but that had happened before 1988-89 when uniformity in the previous year was brought about. But now and onwards, the previous year will be of complete 12 months. Previous year as defined in section 3. Previous year is the financial year immediately preceding the assessment year. For the example, for instance, for the assessment year 2012 and 2013, the immediately preceding financial year 11 and 12 is the previous year. Suppose Mr. X has earned income in 2011 and 12, say from 1st April to 31st March 2012, that will be taxable in the next year, and next year is called the assessment year, that is 2012 and 2013. Now, in respect of previous year, we can say that previous is also assessment year for the last previous year. It means the previous year has got two roles. First is the previous year for the same year, but that is assessment year for the years which has already expired or lapsed. Normally what happens, income earned in the previous year is subject to taxation in the next year, and next year is the assessment year. Or for example, income earned in 2011-12 is taxable in the assessment year 2012 and 2013. But there are some certain exceptions in which we find the rule that the income of the previous year is assessable as the income of the immediately following assessment year, and these exception has been enumerated in different sections. First is income of non-resident from shipping, section 172. Now, as per section 172, if there is a non-resident assessee who is engaged in the business of transporting livestock, animals and goods from India to other country through seaways and is not represented by anyone in India, then income taken place in the previous year is taxable in the same year. But this exception is not applicable if that non-resident assessee is, we can say, represented by anyone in India, or a person who is not a non-resident, he is a resident. In that case, section 172 will not be operative. Now, second is income of person living India either permanently or for a longer period, section 174. Now, there is a person who wants to live India either permanently and for a longer period and is not expected to come back to India in near future. Then income so earned up to the date of departure is taxable in the same year. For example, Mr. X, he wants to leave the country on 1st July 2011. Now, income earned up to 30th June 2011 is taxable in the previous year 2011 and 2012. He will not be permitted to file the return after the end of the previous year. But if he goes outside India for some time and is expected to come back to India in the same previous year, then he may file the return of income after the end of the previous year. Now, third is income of bodies formed for short duration, section 174A. Suppose there is a group of person or there is a body of individuals which has been set up to undertake a particular venture or a business, and as soon as that particular venture and object of business is over, then there is no more in existence of that type of the EOP and BOI. In that case, income so earned by the completion of that work is taxable in the very year in which that work or venture is over. Fourth is income of a person trying to alienate his asset with a view to be away from tax liability, section 175. Suppose income tax authorities get some reliable information that a particular person is involved in illegitimate activities or in some illegal work, so that he minimize the tax liability, he may be away from tax liability. So, in that case, income tax authority may take action against that person and his income can be assessed in the same year, so as to protect the revenue of the government. And finally, income of a discontinued business. Now, this is enumerated in section 176. Now, in this case, a business has been doing by the assessee for last so many years, but that comes to end in the previous year, then income so earned of that discontinued business is taxable in the same year in which the business come to an close. But however, in this case, assessee is permitted to file the return after 31st March, or we can say after the end of the previous year, if he has got other types of the business. But this can be done only with the prior permission of the income tax authorities. And it is very important to note that authority has no power to give the permission to assessee to file the return after 31st March or say after the end of the previous year in first 4 circumstances. Friends, we today discussed what is the assessment year. As you know that income earned in the previous year is taxable in the assessment year. Section 2 subsection 9, assessment year means the period of 12 months commencing on the first day of April every year. It means as soon as the previous year is over, the assessment year will follow. Now, what we do in the previous year? We have to pay the tax on the basis of the income which has taken place in the previous year. Suppose income which has taken place in 2011 and 12 will be taxable in 2012 and 2013. Now, so far as the assessment year is concerned, This is also previous year for the current year, but this is assessment year for the last previous year. Now, in this year, whenever we have to calculate tax liability, we have to see the rate of income tax as contained in relevant Finance Act. Now, Finance Act is nothing, but this is passed by the Parliament every year. So, we have to refer Finance Act only for the purpose of knowing what the rate of tax which has to be used for calculating tax liability of an SSC. Now, since we know that previous year is mean for the earning the income and assessment year is for paying the tax. So, we can say the income of a previous year of an SSC is taxed during the next following assessment year at the rates prescribed by the relevant Finance Act. Now, we discuss what is the person. The definition as given of person includes an individual. Individual means a natural person, that includes man, woman, minor or any type of we can say natural persons. Second is Hindu undivided family. Now, this term is not defined under the Income Tax Act 1961, but we can say that Hindu undivided family is the association of members of the family, they relate to the same family, or we can say that this type of the arrangement is made with the help of the male members and unmarried daughters of the family, and they belong to the same ancestor. Now, third is company. Company means the company that includes two types of the company, Indian company and foreign company. Indian company is a company which is incorporated under Companies Act 1956, and foreign company which is registered firm outside India. A firm means a partnership firm which is under the Act Partnership Act 1932. Now, the term person also includes an association of persons and body of individuals. If any association of persons cannot be termed as a firm, that is included under the definition of association of a person. For example, club is the unique example of association of person. And last is every artificial judicial person not falling within any of the preceding categories. It means any person who does not fall first 5 categories is included under the last category. Now, under this category we can include every type of we can say judicial authorities, we include all legal entities or autonomous bodies like the universities, or every type of the trust and trust which runs all religious places, they are also included under every artificial judicial person. But it is very important to note that a definition of person as given in the Act is not exhaustive, it is inclusive. It means anything is left out from the definition of person is automatically included under the term of person. Now, SSC means every SSC is a person, but every person need not to be an SSC. It means every person cannot be considered as an SSC. SSC means a person by whom any tax or any other sum of money, say interest or penalty, is payable under this Act. It means a person becomes an SSC only when his income is taxable and is liable to pay the tax to the income tax authorities. At the same time, if he makes some default in paying the tax, or if he does not comply with the provision of the Act, then he is required to pay some sort of penalty. In that case, a person is considered also as an SSC. Normally, what happens? A person is required to pay the tax in respect of his own income, but when a person is called upon to pay the tax in respect of income belonging to others is called deemed SSC. Deemed SSC includes a representative of a non-resident. As we discussed earlier, section 172, if any non-resident who is involved in carrying the goods from India to other countries through seaways and he is appointed his agent in India, that agent is considered as deemed SSC of that non-resident SSC. At the same time, if there is a minor person whose income is he is earning some income and that is above 1,500 per annum in the previous year, then that income is to be clubbed with either his father or with his mother, whomever income is greater. But there is some circumstances in which if income earned by the minor person on his own capabilities, he is professionally very sound, or is handicapped, he is a child labor, then his income is taxable of course, but a minor cannot be an assessee. His income is taxable and tax will be paid by his father or by his mother as deemed assessee. In the same case, there are trust and trustee. Trustee is considered as the deemed assessee of trust. Now, fourth is assessee in default. A person fails to deduct the tax from the amount payable by him. Assessee in default means when a person is required to deduct tax before the income is paid out, and if he fails to do so and he makes the payment without TDS or say tax deducted at source, then that person is bound to pay the tax out of his own pocket, but the tax is related to a income which is paid to other person. So, we can say that assessee in default means a person who does not comply with the provisions of the act, and on that account he is liable to pay the tax. Dear friends, we have to understand very clearly what is the meaning of income, because unless we know what is the income, we cannot calculate taxable income and tax liability as well. Now, term income is defined under section 2 subsection 24. The term income as defined in the act is inclusive and not exhaustive. Dear friends, definition of income as given in section 2 section 24 is so exhaustive that we will be discussing the term income as defined in the act at appropriate levels. But in order to understand the meaning of income as given in section 2 subsection 24, it is worthwhile that we should know what is the meaning of income that generally understood. First is regular and definite source. Definitely there are some source of income which are regular in nature, and there are some sources which are irregular in nature. For example, if person is employed somewhere, he is getting salary, that is a regular source of income. But a person who wins casual income, he wins lottery ticket, it is irregular nature of source of income, but both are equally taxable under this act. Now, there are different forms of income. You may earn income in monetary terms, you may earn income in some kind, but both are equally taxable. But income which is earned in kind is valued as per the rules which are contained income tax rules 1962, and if we do not find for valuation of such income in income tax rules 1962, then market value will be taken for the purpose of valuation of such kind of income. Now, third is illegal income. Now, under Income Tax Act, we do not discriminate between what is legal source of income, what is we can say illegal source of income, because both are equally taxable under Income Tax Act 1961. So, we can say that legality of source of income has no significance relevance so far as calculation of taxable income and tax liability is concerned. Now, fourth is disputed title of income. Suppose there is an income, but this title of that income is quite disputed, but on that ground we cannot hold up the assessment of the income, that cannot be postponed. Income is quite taxable, but income is taxable for a person who is in receipt of the income. Now, next is income includes loss. It means income does not mean only positive income, that also covers losses. For example, Mr. X is doing two types of the business. First business has given the income of rupees 2 lakh, but second business has given the loss of rupees 50,000. In this case, income 1,50,000 will be taxable, because loss is always reduced from the income of the first business. Now, next is pin money. Pin money means if any amount which is given by the husband to his wife for her personal expenditure, and he saves something out of that money, is called pin money, but pin money is never taxable. And finally, burden of proof. It means if there is a receipt has taken place, and authority, it is up to the authority to prove to the assessee that the receipt is considered as a income. But if income has taken place and assessee wants to get some exemption in respect of that income, then assessee has to prove to the authority that how the income is exempted under the Act. Now, friends, we discuss what is gross total income. As per section 14, aggregate of taxable income of following 5 heads of the income is considered as gross total income. Now, gross total income covers 5 heads of the income. First is income from salaries. Now, this head is covered by the section 15 to 17. It means this head is covered by 3 sections 15, 16 and 17. Now, under this head, any income earned by the assessee in a capacity of an employee for rendering services to his employer is taxable. Now, second is income from house property. Now, this head is covered by the section 22 to 27. Now, under this head, annual value of the house property or land attached to the house property is taxable, provided the property is owned by the assessee and property is not used by the assessee for his own business and professional purposes, of which income is taxable under the head income from business and profession. Profit and gains of business and profession, and this is covered by the section 28 to 44 D. Now, if any assessee earns income by doing some business and professional activities, or if he is involved in some professional activities, whatever he earns is taxable under the head income from business and profession. And for this purpose, we had to refer sections 28 to 44 D. And fourth is capital gains. Now, this head is covered by the section 45 to 55. Now, under this head, income becomes taxable only when 3 conditions are duly satisfied. First of all, the asset which is so transferred must be essentially a capital asset, might be short term capital asset and long term capital asset. And second is, asset must be transferred in the relevant previous year. And third, transfer must result profit or loss. And lastly is income from other sources. Now, this head is covered by the section 56 to 59. Now, under this head, those income which are not covered by the first 4 heads of the incomes are included under this head. But under this head, 3 incomes are specifically taxable. First is dividend, second is casual income, and third, any gift which is received by a person in the previous year, not from his relative, not account of his marriage, not we can say under the will or in contemplation of the death. Now, what is total income? We know that gross total income is not taxable. Gross total income is subject to further deductions. Now, further deductions which are available under section 80C to 80U. It means, whenever we have to calculate total taxable income, we had to reduce those deductions which are available under section 80C to 80U, so that total taxable is calculated and that is accordingly taxable. Now, income so calculated of course is taxable, but it is required to be rounded off in multiple of rupees 10. So, we can say for the purpose of calculating amount of income tax, taxable income is rounded off in multiple of rupees 10. It means, if a person is earning rupees 2,49,534, then the rounded off income will be rupees 2,49,530. Suppose income is 2,49,535, then he is required to pay the tax on the basis of rupees 2,49,540. I would like to also say that tax liability is also rounded off in multiple rupees 10. Suppose tax liability comes to rupees 2015, then an assessor is required to pay the tax rupees 2030. And if tax liability comes to rupees 2013, then is required to pay the tax only of rupees 2010. Dear viewers, we have discussed today what is income tax law, and in order to understand the income tax law, we have to have the knowledge of the Income Tax Act 1961, Income Tax Rules 1962, circulars and notifications issued by the CBDT from time to time, and there are some judicial decision given by the Supreme Court. Now, whenever we have to calculate income, we have discussed what is the previous year. Previous year, as I told you, that is complete 12 months, might be shorter than 12 months in case of newly set up business, and it will not exceed 12 months. Now, assessor has no right to pick up the previous year of his choice. He has to adopt the previous year commencing from 1st April and 31st March of the next year. After that, we have discussed that income so earned in the previous year is taxable in the next year, but we have also found some certain exceptions which are laid down and contained in section 172, 174, 174A, 175 and 176. After that, we also discuss what is the assessment year, and we also discuss who is an assessee, who can be a person, and when a person becomes an assessee, and we also discuss who is considered as deemed assessee and what are the circumstances in which assessee can be considered as assessee in default. After that, we have discussed what is the income, and in respect to income we have touched upon some general points. After that, we have discussed what is the gross total income and what is the total taxable income, and for the purpose of tax liability we have to calculate total taxable income, but this is calculated in multiple of rupees 10, and tax liability is also calculated in multiple of rupees 10. So, that we have discussed, that we have covered in our lecture. Now, previous year means the year that is commencing from 1st April and ends on 31st March of the next year. Now, this is uniform previous year. Why? Because every assessee under the Income Tax Act is bound to adopt this type of the previous year beginning from 1st April and ends on 31st March of the next year, or we can say that assessee has no liberty to adopt the previous year other than this. So, we can say the income of a previous year of an assessee is taxed during the next following assessment year at the rates prescribed by the relevant Finance Act. As per section 14, aggregate of taxable income of following 5 heads of the income is considered as gross total income.